we are now capable of saying that most likely this year we'll have double-digit growth across the global economy when it comes to earnings. When you look at the global picture, you want to say that it's probably a good time to be invested. The hyperscalers are deploying hundreds of billions of dollars every year to deploy in AI. Increasingly now, we are seeing concrete proof of return on investment. We believe that those return on investment are here to stay and could accelerate. When it comes to credit, we typically tend to speak of a golden age, but beyond that, you can build portfolio carrying 6, 7, 8% right now.
Welcome to this new episode of Tikehau Market Outlook. With our experts, we aim to shed light on the forces at play and the opportunities taking shape. Don't forget to subscribe to our YouTube channel to stay up to date with all the latest news from Tikehau Capital. Geopolitical tensions, demanding valuation, and the rise of AI, markets are navigating a complex yet supportive environment. To discuss this with me today, Raphaël Thuin, Head of Capital Market Strategies. So Raphaël, since the beginning of the year, markets have continued to move higher, even as geopolitical tensions, inflation concerns, and uncertainty around central banks remain very present. How do you explain this resilience in risk assets?
Yeah, when you look at the macro global picture, you could argue that there are actually two opposing forces right now, one negative, one positive for the markets and for the global macro environment. On the negative side, you have geopolitics, you have Iran. And this has been characterized by a several-step process affecting the macro and the global economy. The first step has been around energy. Energy prices, oil and nat gas in Europe, for instance, have risen quite tremendously during the Iran crisis and obviously had a huge impact on the economy. The one domino effect there is about inflation. Inflation has risen fast as well, and inflation expectations by consumers and industrials have risen as well. The last domino effect, the last step in the process affecting the global economy has been around interest rates. Expectations are high now that central banks and monetary policy would be less accommodative down the line, and this has acted as a global headwind for markets and the economy. That's on the negative. Another different positive momentum there is around earnings. We went through the first quarter earnings season. It was a historical earnings season when it comes to profitability, when it comes to revenue growth. And we've seen a very strong momentum across the board from the US, from AI, but not only. Actually, the leadership has been fairly broadened beyond those factors. And we are now capable of saying that most likely this year we'll have double-digit growth across the global economy when it comes to earnings. So yes, two opposing forces characterizing the macro environment. At the end of the day, when you look at the global picture, you want to say that it's probably a good time to be invested. We probably saw somewhat of an inflection point when it comes to energy prices, inflation, interest rates on the one hand. And at the same time, we are still fairly confident that the momentum around earnings could continue. So yes, probably a good time to stay invested in this market.
Moving to equities, what opportunities do you currently see in the equity markets? Are we in an AI bubble? And also, what about Europe after a rocky start to the year?
So when it comes for equities, we keep in mind that this is a high dispersion environment. There are winners and losers. Some sectors are badly affected by higher energy prices, competition from China, tariffs from the US. Other sectors are benefiting from, CapEx momentum across the globe. And so you will have to be very selective when it comes to allocation. We identify a few areas right now where we feel there is very strong value to be invested, one being European defense. It has underperformed year to date. You're seeing some skepticism somewhat among investors after such a massive run on the upside and some consolidation around defense in Europe, we feel it's probably a good entry point. Valuations have come down, and when it comes to the fundamentals of those companies, they are still flashing green. It's a mega trend in the making. Years of order books ahead for those large industrial companies, and margins are also improving. So once again, at a time of lower valuation, we feel it's a good entry point. So that's one idea. Another idea still in Europe, for the most part, is around cyclical names, industrial names. They suffer tremendously from Iran and from higher energy prices. We feel it's a good entry point now. Once again, back to this idea of inflection point. If we were to see somewhat of a relief when it comes to energy prices and interest rates, they will be the first one to benefit. And think broadly in Europe, you have fiscal stimulus this year, especially coming from Germany, potentially valuations also which have come down and which are very discounted compared to the US especially. So at the end of the day, it's a good mix to be invested in those names in Europe. One last idea, something you mentioned, AI, tech, obviously one driving factor for the market. We are seeing some areas of speculation there, excesses for sure, but we still believe that this is a long-term trend that one investor has to own in the portfolio. Be selective there, but remember, we are seeing a lot of capex being deployed in the space. The hyperscalers are deploying hundreds of billions of dollars every year to deploy in AI. There was somewhat of a skepticism around the return on investment of this capex. Increasingly now, we are seeing concrete proof of return on investment and the reasons why those hyperscalers have been so pushy into deploying in the space. We believe that those return on investment are here to stay and could accelerate. So still constructive there.
Very interesting, thank you. Let's turn now to credit. Does this environment remain as supportive? And in this context, how are you building your portfolios?
So when it comes to credit, we typically tend to speak of a golden age for credit and for carry strategy, compounding strategy. What you get right now is fairly high yields in the portfolio, in the market, not necessarily because credit spreads are wide. They're actually not super wide, and we don't love credit spreads where they are, but mostly because interest rates are very high. We mentioned inflection point, we'll see what happens, but beyond that, you can build portfolio carrying 6, 7, 8% right now, investing in quality companies where default rates are relatively low or very low, where fundamentals are strong, profitable companies. And at those levels of carry, once again, you can build this mattress in your portfolio of low volatility, good performance, which is fairly unique when you look back over the last 15 years. Having such a high carry potential in quality names is an interesting value proposition. So carry and, broadly speaking, credit investing has a place in an allocation.
Perfect, thank you. Well, selectivity in equities, strong convictions on European sovereignty, and credit remaining a key pillar. Those are the key messages for navigating the second half of this year. Thank you very much, Raphaël, and we'll see you very soon again.